Hello and welcome. As fuel costs start to inch up at the pump, the direct impact will happen with regard to logistics operators, and TCI is one of them. Transport Corporation of India is one of those. Of course, West Asia, the slowing EXIM trade which is playing out, some of those trends hurting the stock price, and you're seeing the 12-month stock price is down 18% over the last 12 months, of course. But you look at the stock price from the highs of around 1250, and we've seen a significant correction. Stock is just off the lows. There's very little debt, and therefore risk from a downside perspective is only that business slows down. And we'll try and get a sense as to what's playing out. One, of course, business slows down. Second is the hit on margins on the back of lower utilizations and higher fuel costs. We'll try and get a sense of a lot of those pieces with Vineet Agarwal, who's the Managing Director at Transport Corporation, who will join us in just a bit. In terms of why it's interesting, I've highlighted most of those. Just the one critical piece from an investor lens is the fact that shipping margins, which are extremely high, can they sustain or not? Transport Corporation enjoys an EBIT margin on shipping, which is north of 30%, when your overall EBITDA is at around 10 to 11%. So therefore, shipping is where a bulk of the EBIT actually comes from, or the EBITDA contribution actually comes from. Can that really sustain as a business vertical is the question. Now, about the company, incorporated in 1958. It's one of the first logistics companies in India, but operating since 1958, but incorporated in 1995. And that's Transport Corporation for you. It's got a market cap of around 7,500 crore. You've got it being called one of the largest integrated multimodal logistics and supply chain providers in the country, and it operates in road, rail, coastal shipping, warehousing, and cold chain. So it's got a confluence of all of those. That's what makes it unique. In terms of products, let me first start off and try and break it down, maybe give you a bit of flavor with regard to the model as well. TCI Freight is nothing but trucks. Now, trucks are of two sorts. One is owned and one is contracted. So they do both. TCI does both. They have owned trucks as well as contracted trucks. Now, truckload is, again, two types of truckload that are there. One is full and one is less than truckload. Less than truckload have double the margins than the full truckload. Why is the full truckload on a lower margin? Because a single client comes, books the truck entirely, loads the truck up fully typically, and therefore your margins are lower. With a less than truckload, under the less than truckload model, a bunch of customers are clubbed together in a single truck, and that makes the margins better, because on each customer you can make a slightly better margin. So in fact, the margins are double, so 10 versus 20 literally, and that is the essence of what you need to understand with regard to truckload. Then there's over-dimensional cargo, which is large cargo, bulk cargo, transformer units, industrial reactors, construction equipment, turbine blades. These are difficult to move, and TCI does that as well. Then there's project logistics. You need a particular material spread over 18 months to get it just in time to ensure that it doesn't get spoiled or it doesn't need storage. That is something that TCI does. So that's project level logistics. Then there's cross-border logistics, which is to Bangladesh and the like. You have to go through all your compliances, which TCI takes care of. You have containerized road transport. Now, you've got trucks doing road transport, and then you have containers, flatbed trucks, on top of which containers are stacked, and that is transported. Why is that better? And these days, that has the quantum of customers opting for that has gone up, because you want to preserve the quality of whatever is being transported. If it's electronics or pharmaceutical products, typically you will book a container because you could see adverse weather. But even otherwise, now you've started to see an inch up with regard to containerized road transport, which is slightly better in terms of margins. Then you have TCI behaving like a custom house agent, which is ensuring that customs, that goods clear customs. You have chemical logistics, specific trucks or containers used for the purpose of transport of chemicals. Then there's inbound factory logistics, there's warehousing, and inbound factory logistics are nothing but you need a set of materials over, say 50 different components delivered at just the right time in the right sequence. So that is something that TCI takes care of as well for factories and for manufacturers. There's warehousing, of course, that they take care of. In the middle of all of the transport and the logistics that they manage, warehousing is also a part of it. There's multimodal rail logistics. So them along with Concor have a JV, and they manage rail logistics as well. So if rail is more optimal from a time or a cost perspective, they use rail as well. And then there is, and within that, there is, of course, the dedicated freight corridor tailwind, which is also coming through, which reduces time and which reduces costs and which improves margins for logistics players. So all of that. Then you have, in terms of seaways, seaways is actually slower but cheaper. Say you want to move goods from Gujarat to Chennai. Sometimes it could well be optimal to move it by sea, even though it's slower than maybe through train or through a dedicated freight corridor. Because sea transport is cheaper, the ships are owned by TCI. TCI owns 6 ships, so once the ships are loaded, and if at all there's a ship going anyway, it could just be incrementally far better from a margin standpoint. The entire revenue accrues to TCI. And TCI is one of the few companies which actually does seaways as well. In fact, Andamans, all of the cargo that goes there goes through TCI's ships. So that's, again, a dedicated opportunity which TCI taps into. Then there's cold chain. There's a JV with Mitsui Japan, which TCI operates. And then there's TCI Concor, which is the JV with Concor. So both of those is the other opportunity which TCI has. In terms of geography, 99% is India, 1% is abroad, but of course the dependence is with regard to EXIM as well. And we'll try and get a sense as to how much that dependence is. Networks, it operates on a hub and spoke model, 25 hubs, 900 branches, 70 terminals, 600 yards is how they operate broadly in terms of their operations. They hire or own trucks, they have 6 ships. And in terms of road, of course, they have strong competition, but for ships, not so much. So that's really the differentiator. This is, of course, the financials, and you're seeing it on your screen, 9% growth over the last 3 years. Really, growth needs to start to move upwards, and we'll get a sense. But of course, this year as well, you'll likely see some bit of a drag given the evolving macro. You're looking at EBITDA growth of just about 7%. And PAT growth of roughly about 13%. Some bit of operational efficiency playing out on profitability on your screen. So 13% PAT growth, 3-year CAGR. In terms of margins, let's pull those up, and that'll give you the operational metrics from 11 point, generally hovers around 10 to 11% in terms of the margin trajectory. But what they really depend on is the seaways margins, and that's where the possible questions lie as to whether those can sustain in the medium term or not. In terms of balance sheet, you've got around 2,500 crore of equity lying on the balance sheet, which means that it trades at around 3 times book. You've got a borrowing number of around 200 crore on the balance sheet there as well, and you've got around cash of around 100 crore. It's a clean balance sheet. There's no concerns there. When you're looking at cash flow, the cash flow conversion is good as well. So no concerns there as well. You're seeing 86% or 85% plus kind of cash flow conversion for FY26. No concerns there either. You're looking at return ratios north of 20%. Again, no concerns there. It's got a very, very decent return ratio profile. So all the capex that's happening is leading to a decent return. Of course, each vertical delivers a different ROCE, and that is something which could be a concern. But outside of that, on a console level, you've got a decent ROCE setup here. In terms of shareholding pattern, 69% owned by the promoters. No concerns there. You've got decent FI and DI participation there as well. And the balance of around 15% is held by the public. In terms of valuations, now again, critically, some of these stocks are trading at their lows. And when you're looking at the kind of 1-year forward PE that this one trades at, it trades at sub 15 times 1-year forward PE. The 5-year average PE is around 17 times, and the range is between 13 and 24 times. So you are trading at maybe a 15% odd discount to your 5-year average valuation. So that definitely looking much more comfortable for a TCI. If growth were to pick up, you could see a surprise here play out. In terms of analyst recommendations, 8 analysts track it, all with a buy call, no holds, no sells. The upside is 26% on a TCI over the next 12 months. Let me go across to Vineet Agarwal, Managing Director, Transport Corporation of India, joining us. Vineet, great having you. Let me first start off by understanding, firstly, petrol and diesel prices on ground. They've gone up. What's the impact on you and your business directly?
Thanks, Harsh. Thanks for having me. And I just heard through the comprehensive coverage on us and greatly appreciate it. And you've covered a lot of the points, and certainly we can talk about a lot more. Currently,
Thank you.
The fuel impact in March was essentially the first thing that happened was bunker prices went up. That is, our shipping prices, the fuel that you use for shipping went up by 100% actually from March onwards. And that has continued to be at a higher level. And that has a direct impact on the operations of the ships. However, we've been also able to increase some of our rates on the shipping side. On the diesel price hikes that have happened, it's about 7.5 rupees approximately across the country, which translates to about 5 to 7% type of an increase. This is a process of essentially during our contracts, we have back-to-back clauses where we pass on this increase. And of course, there's sometimes a lag in terms of pass on, but in most cases, the pass on happens. In some of the retail customers, the pass on is a little slower. But given the fact that in the last few months, or rather at least last 18 months or so, cost structures across the system have been going up, whether it is manpower, lubricants, tires, trucks, and now, of course, fuel. I think some of this pass through is expected. And we should get that as well.
Understood. So no concerns from a roadway standpoint, but from a seaway standpoint, there could be concern on margin, or you'll be able to hold up the 30 to 40% kind of EBIT margin guidance that you've given?
We should be able to hold on to some of that, some of the gains, but some of the margins that we've been having. We've been in the excess of 40%, and I've been saying that 30 to 25, 30, 35% is more reasonable. And I think we should get to that stage. We should probably be at that. Also, there is typically what happens at this time is that if rates in the sea side move up a little bit, some cargo shifts to the road. But now when we see road freight rates going up, we should probably see some cargo shifting to sea. So this play between different modes of transport, I think our customers are very smart and they can see that much more easily, and we see some of that coming to us. The great thing is that we are present in all these areas, and we are able to capture whether it is moving from road to rail, rail to road, and so on between the different modes of transport.
Yeah, that makes a lot of sense. Tell me, Vineet, what's the pulse like on ground from a volume perspective? What was the volume growth that you were penciling in prior to, say, 27th of February? What is it post, and what's the outlook now?
I'll take a step back to actually talk about September also 26, when GST cuts happened. And that GST cut really had a good flip in terms of business increase for Q3 and also Q4. Essentially, we saw that inventory got taken up, whatever inventory was there. For example, we maintain yards for automobile companies. We have about 70 multimodal yards across the country, and we saw substantial amount of inventory there. And all of that got used up, a lot of that got used up and continued to get used up even in Q1 of this fiscal. So the volumes were really good till Feb 28th. We did have actually a very good Q4 as a whole. We could have done better in March, but notwithstanding the war. Some sectors, as you know, with LNG prices going up or LNG completely disappearing, led to some at MSME level, certain level of production cuts. So we could not deliver as much as we wanted to. Going forward, we are also seeing Q1 and Q2 is usually a softer quarter, but we feel that there would be some, the overhang of some of that inventory build-up is continuing. We are seeing inbound logistics growing. we are seeing some replenishment happening, and of course, some final sales happening. Consumer sentiment in some sectors is slightly softer, is what we are seeing. Some consumer durable companies have taken a little bit of a price hike, and that might have had some impact in some areas. But the sales of, for example, televisions, refrigerators, etc., continue to do very well.
That's very heartening to hear. And Vineet, if I were to push you to probably give us a sense, is EXIM impacting you? The fact that there's been such an overhang with regard to exports and imports, especially to and from the Middle East, is that impacting you at all? If you can give us some color on that, directly or indirectly.
Yes, so as we do not do EXIM, we're not in the EXIM trade, it does not affect us directly. Indirectly, certain customers who are importing products and who we used to do transportation. For example, we do manage transportation for several companies for chemical logistics using rail. And typically, a cargo would come on a ship from the Middle East. They would dock on the ports, and then we would move them by rail across the country. Now, some of that has not happened yet, and some of that has gotten disrupted. On the export side, we are also seeing that some types of customers who are in the MSME side are struggling a little bit. So overall, we feel that the EXIM trade has had an impact indirectly. Also, the other thing to note here is that sometimes when international rates go up in the Middle East, ships tend to move away from the coastal waters into the international waters because they want to get the international rates. In this scenario, some of those sectors being shut, we are also seeing some ships coming to the coastal waters. So this has an impact from a demand supply perspective, but these are usually much more short term in nature.
Okay, and therefore, what should growth look like for you? FY27, broadly, you'll have some price recalibration which will aid growth for you in terms of top line. But what about volume and what are you penciling in overall?
We see the pipeline to be very strong still. The trends around logistics are very good for the country, especially around formalization. We are a formal company, organized company, national company. I think we tend to get some benefits there. Consumer growth or consumer supply chains are changing. For example, quick commerce is something that is growing really well. And we are part of that story where we do replenishment through our warehouses. Then the infrastructure boom that has continued for the last 2 years, which we believe will continue again, considering that the government would like to keep spending, means that logistics sector gets a flip as well. So given all these trends and the pipeline and the fact that we are present in so many diverse areas of logistics should mean that we would, as per our guidance, look at a 10 to 12% on the top line and a similar kind of growth on the bottom line.
Point taken. I'm going to have to take a mandatory commercial here, Vineet. I'm going to have to request you to wait back. And, on the other side, viewers, what we're going to try to quiz Vineet on is how margins are shaping up. So he's given us the perspective on top line as well as bottom line. Likely margins will sustain, but I'm trying to understand two risks here. One is on the sea margins and how that is shaping up. And second is with regard to a truckload and how the trends full versus less than full truckload is playing out and how TCI is taking advantage of that. Let's try and get a sense of that on the other side of this break. Welcome back, and we're in conversation with Vineet Agarwal, who's the Managing Director at Transport Corporation. Lots of nice nuggets to try and understand as to what's happening in the economy, but also with regard to logistics. And Vineet, one pivot that TCI is making is from full truck to less than full truck, and there the margins are materially better. How much of the current composition in terms of the truck revenue comes from full versus less than full, and how you're trying to make that switch? Because it's a big switch for you in terms of margins, if my understanding is right.
That's right. So, the freight business is essentially about 40% of our overall revenues. And in that 40% of that revenues, 36% is our less than truckload business. That's the LTL business, where, as you rightly pointed out, the margins are typically double of the usual FTL margins. Now, we already have a branch network, and actually, the branch network is not 900, but about 1,400 branches across the country. And we have those hubs. So the network is there, the infrastructure is in place. Now we need to really capitalize on that. And we are pushing very hard in terms of how to grow that business. Of course, clearly, one challenge is the MSME sector is not doing as well. So as and when that starts picking up, because MSME might say, I don't want to take a full truck. I just want to move 2 tons of my material, or 1 ton of material, or take these 200 kilograms of items, and the frequency is more, but the quantity is less. So that way, the MSME business does have an impact on the LTL business. But the focus of the company of that particular division has shifted to LCL and not to FTL. So we should see some measurable changes in the next few quarters on this segment growth as well.
And Vineet, so perfect. So that kind of makes a lot of sense, because large customers would prefer the full truck model, and MSME would be the target point for this particular business. Give us a sense now to kind of shift focus on shipping, because you said that EBIT margins were surplus of 40%, right? Now, with crude costs going up for you, does this temporarily dip and thereafter we see a bit of a rebound? So will Q1 be soft on the margin front, is what I'm trying to query.
It would be slightly softer for sure. I think, as I said, some volumes get impacted along with when some rates go up. And typically Q1 is the lower quarter for us. So there could be some minor impact, but I think it should start picking up subsequently, as your guess is as good as mine in terms of whenever this war ends. But I think then right there and then the fuel prices, especially bunker prices, should come down right away. Notwithstanding, in quarter three, end of quarter three and early quarter four is when we are expecting 2 brand new ships that we've ordered. And those 2 brand new ships will be delivered from China. And those will add to our existing capacity of 6 ships. So for the full year end, we are more positive in terms of not just keeping up with the current numbers of last year, but also improving at least on the top line side.
And demand and efficiency is there, Vineet, in terms of you adding 30% more ships. I mean, you call it 2, but it's 2 on top of 6, right? So is demand there to kind of take up the kind of supply that you're putting up?
Yeah, it's 2 on top of 6, but actually in terms of capacity is about 20%. We have about 78,000 tons in terms of capacity today, which will go up by 20%. So yes, there is demand. We've seen that in quarter 3, quarter 4 of last year also. We see that shift happening towards coastal shipping. See, India's coastal shipping business today is only about 6%. Our freight, only 6% moves, whereas in China it is more than 20%. As a country, we need to start using our coastal much better. And that would help us not just in lower pricing, but also in green logistics, because there is less carbon emission versus from road to sea. And we are able to provide that connectivity both on the west and the east coast. And there is enough more demand when we speak to our clients. So yes, this capacity should be easily utilized in a few months of the ships coming in.
And therefore, what's the capex pipeline? Are these 2 ships largely paid for? Will they be paid for when delivered? How does it play out?
50% of that payment has already been made. The ships were roughly about 300 to 325 crores for both the ships. In this year's capex plan, last year we spent about 375 crores. This year we're looking to spend about 550 to 600 crores. Out of that, about 250 crores will go into some part payment for these 2 ships, the final payments, I'm sorry, and a part payment for a possible new ship that we've got the approval from our board. So that is under exploration right now. Apart from the 250 crores, 100 odd crores will go into constructing of new warehouses, about 125 crores into new trucks as well as rakes. We also have 3 automotive rakes that we are adding, and we are adding 2 more, and about 125 crores into warehousing equipment. We manage currently about 17 million square feet of warehousing space, and that, as I gave you the example of quick commerce, is expanding very rapidly for us. So, and that's also a higher margin business. So we do expect that we need to spend on infrastructure inside the warehouses, the racks, the handling equipment, and so on and so forth.
Right. I'm completely out of time, Vineet, but one quick question. Largely internal accruals to take care of all of this, right?
Some amount of debt, but yes, mostly internal accruals.
Excellent. Thank you so much for coming in. This has been excellent in terms of the conversation.
Thank you.
Thank you. And viewers, that's all the time I have. So thanks so much for tuning in.